Good day, this is the Asymmetric Daily Brief for Friday, August 7th, 2026. Here is the shape of today. The American economy lost jobs last month for the first time this cycle, and the 10-year Treasury yield rose anyway. Every reflex built since 2019 says weak payrolls mean the Federal Reserve rides in and yields fall. Today the reflex fired, and the bond market refused to play along. We will take the tape first. Then the three places where we think consensus has this wrong. Then the macro regime, sentiment, sectors, the calendar, and the calls. The board, the S&P 500 sits near 7,704, essentially flat on the session. The Nasdaq Composite is the leader, up about 1.1%, and the Dow is up around 0.3. Now the one that matters. The 10-year Treasury yields roughly 4.68%, and it rose on the day the jobs number went negative. Gold is around $4,305 an ounce and firm, bid on a softer dollar. The dollar index is near 99.6, down about 0.3 after the print, closing out its worst week in roughly 3 months. Bitcoin is $64,745, up 0.33%, with a market capitalization near $1.33 trillion. Crude fell for a third straight session, with West Texas around $75. I will flag that Brent quotes diverged materially across sources today. So treat the crude level as approximate rather than precise, and hold this in the same hand as everything else. The S&P closed above 7,700 for the first time ever on August 3rd, and printed a record with the Dow at 54,000 on August 4th. We are 2 sessions off an all-time high, with a negative payroll print and a rising 10-year. Consensus versus the asymmetric. First read, and it is today's focus. Everyone believes payrolls went negative, therefore the Federal Reserve cuts. The tell says the next move is more likely a hike, and the bond market said so out loud. Payrolls fell 23,000 against an expected gain of 83,000. That is a miss more than 100,000 jobs wide, but the unemployment rate fell to 4.1%. Because the labor force participation rate dropped to 61.4%, the lowest in more than 5 years. Average hourly earnings cooled to 3.2% year-over-year, the softest since May 2021. This is not a demand collapse. It is a shrinking labor supply, and a shrinking workforce lowers the economy's non-inflationary speed limit rather than raising it. Here are the two numbers: a gain of 83,000 expected, a loss of 23,000 delivered, and underneath it, the revisions did as much damage as the headline. Government payrolls fell 53,000. May and June were revised down by a combined 103,000, with June cut all the way to 20,000. So the trend everybody thought they were reading last month was quietly a weaker trend the entire time. The futures market's own tracking tool now puts a greater than 90% probability that the federal funds rate ends this year higher than it is today. Second read, everyone believes American oil imports from Saudi Arabia hitting zero means a structural decoupling. The tell says it is a war disruption, and the barrels are already on their way back. United States imports of Saudi crude was zero for the entire month of July. That is the first full month since 1985, and it comes down from more than 800,000 barrels a day earlier this year. But refiners did not stop buying oil. They backfilled. And Venezuelan crude jumped from about 100,000 barrels a day to roughly 600,000 after sanctions licenses were expanded. Meanwhile, crude prices fell 3 sessions running on talk of de-escalation in the Strait of Hormuz. A genuine structural decoupling does not arrive with a de-escalation bid attached to it. 800,000 barrels a day earlier this year, zero in July. It is a genuinely historic number, and it is being read almost universally as a permanent realignment. We would be careful with that. The cause is the disruption to Gulf flows from the conflict with Iran, not an American decision to stop buying Saudi oil, and the substitution into Venezuelan barrels shows the demand never went anywhere. The barrel had to come from somewhere, and it did. Third read, everyone believes the market is pricing a Federal Reserve rescue. The tell says 3 different venues are pricing 3 incompatible Federal Reserves, and somebody is very badly wrong. Rate futures cut September hike odds immediately after the print. Prediction, markets have been carrying a September cut near a coin flip, while simultaneously carrying majority odds on 0 cuts for the whole of 2026. And the exchange's tracking tool puts better than 90% odds that rates end the year higher. Those cannot all be right. When the dispersion in the policy path is this wide, the interesting thing is not a directional bet on which one wins. It is that volatility itself is being sold cheaply into it. We take no view on which leg breaks. We are simply noting that the disagreement is unusually large and the price of hedging it is unusually low. Follow the money, start with rates. The Federal Reserve held at 3.5 to 3.75% on July 29th, and 3 officials dissented in favor of a hike. Read that again. The internal argument at the last meeting was about tightening. The Consumer Price Index ran 3.5% year-over-year in June, above the 2% target, where it has been since 2021. Chair Kevin Warsh, in the job since May 13th, has deliberately abandoned forward guidance. His stated mandate is to deliver price stability. A central bank that does not guide is one whose reaction function you have to infer from inflation data rather than from speeches. Today's print handed the doves the headline and handed the hawks everything underneath it. The dollar and gold. The dollar index slipped about 0.3% after the jobs print and finished its worst week in roughly 3 months. Gold sits above $4,300 an ounce and firm, and the driver is straightforwardly that softer dollar. We are deliberately not quoting a year-to-date percentage on gold. The level and the driver are the honest units, and the percentages floating around are contested. Now the story almost nobody is pricing. The United States and Japan executed their first coordinated yen intervention since 1998, after the yen hit a 40-year low near 164. The Treasury is reportedly pushing to expand the Federal Reserve's foreign repo facility so that Japan can raise dollars without liquidating its roughly $1.1 trillion of treasuries. That last clause is the entire risk in a single sentence. Officials are building plumbing specifically to prevent a forced treasury sale. You do not build that unless you have modeled the alternative. The yen carry trade is the channel that turns a Japanese rate move into a global margin call, and it is getting a fraction of the attention the jobs print got. Artificial intelligence capital. This has stopped being a sector story and become a macro line item. Apollo's Torsten Slock estimates that data center capital expenditure is now adding roughly 1.7 percentage points to gross domestic product. I want to be careful there. That is a third-party estimate as circulated, not a government statistic. Separately, the research shop IO Fund puts 2026 big technology capital expenditure guidance at $732.5 billion, which they calculate as 158% above forecasts from September 2024. Those figures are their own reporting of company guidance, and we have not independently verified them, so treat them as directional. But the uncomfortable symmetry holds regardless of the exact number. The bull case and the recession case are the same line. If capital expenditure is carrying nearly 2 points of growth, then a capital expenditure pause is the recession. Crypto policy. The Clarity Act did not get its vote before the recess. The Senate Majority Leader confirmed there would be no August vote, and the Senate returns on September 14th. Prediction markets sit near 30% that it becomes law in 2026. The bill cleared the House 294 to 134 and cleared Senate banking 15 to 9. So it is not dead, it is late, but delay compounds. Because every recess raises the odds this slips past the midterms entirely, and a bill that misses a midterm rarely comes back looking the same. Market sentiment. Drawing on market and social sentiment monitoring alongside a review of long-form financial media, the split today was unusually instructive. The loudest commentary spent the day on the crypto bill, treating a Senate vote as imminent, and was proven wrong within hours. Meanwhile, the long-form financial channels had already called that outcome a day early. The reverse was true on the jobs print, where the fast commentary was minutes fresh and the long-form side was still litigating a September hike. The synthesis is worth keeping. The fast surfaces are good for the tape. The slow surfaces are better for the regime, and both of them, today, badly undercovered Japan. Tell one chart, and it is not a chart, it is a direction. The 10-year Treasury yield rose on a negative payroll print. Since 2019, the entire long-duration complex has been trained on one reflex. Bad labor data, then easing, then lower yields, then long-duration assets rally. Today, the labor data came in worse than any forecast on the street, and the bond market moved the other way. There are only two explanations available, and both are uncomfortable. Either the market believes Treasury supply overwhelms any plausible easing cycle, or it believes a central bank sitting on 3.5% inflation with 3 hike descents on the record simply will not ease into a participation-driven jobs miss. Probably both. Either way, the conclusion for anyone holding long-duration risk 2 sessions after an all-time high is identical. The put you think you own is not priced where you think it is. Sectors in play, energy first. The bear case is that Saudi imports at zero is a supply chain dislocation rather than a demand signal, and the market is trading the reopening. The bull case is that the Iran and Oman transit deal the tape is pricing has been rejected by the Trump administration and is still sitting in Iran's parliament. The read is that positioning is long de-escalation on a deal one of the principals has already refused. Semiconductors and artificial intelligence infrastructure. SpaceX and Tesla committed $16.8 billion to a chip fabrication plant in Grimes County, Texas, called Terafab, spanning more than 100 million square feet at full build-out, with Intel now participating. The bear case is that this is precisely the debt and capital intensity that a hiking central bank punishes. The read is that the build-out is real and the financing regime underneath it is changing at the same time. And crypto. Exchange flows ran one-directional into venues this week, a classic sell pressure tell, with Bitcoin soft and dominance near 56.7%. Worse, the cold card exploit drained roughly 1,816 Bitcoin, about $116 million, across more than 5,200 addresses. The cause was a March 2021 build configuration error that fell back to a weak software random number generator, collapsing effective key strength from 128 bits to as little as 40. That is brute forcible without physical access to the device. The read is that cold storage was never the threat model. Entropy quality was. And note carefully, patched firmware alone is not sufficient. Affected users must migrate to newly generated seeds. On the radar, first and most important, watch the 10-year yield on the next soft economic print. If yields keep rising on weak numbers, the bad news is good news. Bid in equities breaks quickly. Second, Iran's parliament on the Oman and Hormuz text. The United States has already rejected it, so a parliamentary pass combined with an American refusal is the tail risk oil is not priced for. Third, commentary from the chair into September. 3 July dissents were for a hike, and a hawkish clarification from here would be violent. Fourth, the G20 gathering in late August, where we are watching for confirmation of the Japan liquidity backstops. Fifth, September 14th, when the Senate returns with roughly 3 weeks of runway before the calendar turns political. And sixth, any fifth wave in the cold card exploit, which would turn a wallet story into a self-custody confidence event. The scorecard, 3 new falsifiable calls, dated today, each stated so it can be graded. Call 68A. By the September decision, the federal funds target will not be lower than 3.5 to 3.75%. That is wrong if the Federal Reserve cuts in September. Call 68B. United States imports of Saudi crude will print above zero for August, because this was a war disruption rather than a structural break. That is wrong if August also prints zero. Call 68C. Within 60 days, the Clarity Act will still not be law. That is wrong if it is signed before October 6th. And we carry forward the artificial intelligence capital expenditure as macro framing from issue 66, which was reinforced today by the gross domestic product contribution estimate. The close, 2 sessions ago the S&P printed an all-time high. Today the economy printed job losses and the 10-year went up anyway. The question worth sitting with is not whether the Federal Reserve cuts in September. It is what you actually own if it does not. Most portfolios built over the last 6 years have an implicit central bank put embedded in them, not as a position anybody chose, but as an assumption nobody re-examines. Today the bond market quoted that assumption and the price came back higher than people think. We are watching the 10-year on the next soft data point. That is the whole test. Today's single thesis in full is in the focus, link in the description. This has been the Asymmetric Daily Brief. Research and education only, not financial advice. One contrarian read a day. Subscribe.